Hello, everyone. My name is Robin Dolezal. Today is Tuesday, May 3rd. With me, as always, is Alex Pars and Dan Nentel. Together, we are with Ironwood Financial. Hello, gentlemen.
How's it going?
There.
Good. How are you guys doing today?
Good, good.
Man, the weather in Tucson is great today, gentlemen. I was just doing the where was I at the school doing what do you call it, playground duty. And we had this nice blanket of clouds with a nice breeze. It was wonderful because we touched 100 degrees last week or 10 days ago or so.
I thought we missed it.
Did we? Okay. Well, it was darn close.
Yeah.
Yeah. Well, Daniel, I hear there's a happy birthday in order in your family.
Yeah. I'm shocked, actually. I was looking at some things, but my middle son is 17 today.
17.
I know. And if you want to put it even worse, even more in perspective, my youngest got his driver's permit yesterday. 3 drivers in the Nentel household, plus the 2 adults.
That's
Wow.
crazy. I still remember when I first met Dan, Ellie was just born. I mean, literally just born, brand new baby. So
Yeah.
I can't believe 17 years for the middle child. That's crazy. Time flies.
That is for
Well,
sure.
you guys have plans for this weekend? We got Mother's Day weekend coming up.
Guess we should make some plans.
All right. Well, we do have plans. We're gonna go up to, I think, Sedona this weekend, do a little bit of camping. So that should be fun.
Oh, that's perfect.
Yeah, perfect. Well, I know it was only 2 weeks ago, guys. It's been a short stint since we last met, but there's been crazy stuff going on in the market. We've got a couple emails, so we'll figure. We still haven't heard from the Fed. The Fed is meeting as we speak. They will be speaking today and tomorrow, and then we'll know more. And I assume we'll do another one of these after. But let's just kind of get together again and chat about what's going on. Dan, let's start with you. I tell you what, Daniel, I saw green today on the screen.
That's right. Well, it depends on when you looked. It was red this morning, then green, then red, then green. And it's actually, today's a good microcosm of what's happened this year. We've been saying quite some time that there's going to be a lot of volatility this year, at least in everything I've been reading, maybe not all year, but until at least into third quarter, maybe mid third quarter, we might see the volatility subside. But what happens is we're super upset because the inflation numbers are so high, and rightfully so. Now, again, for some reason, I'm naive, and Alex kind of battles me on this, saying, Dan, you are naive, but when you actually stimulate the economy with this much money, and then you shut down the country that makes most of our goods, and people have money, it seems to me you're going to have outrageous inflation. So I'm still of the belief that sometime mid 2023, and you can find a lot of pundits saying the same thing, that we might see inflation subside a little bit sometime mid next year. But when there is inflation, I was reading the chairman of the Fed back in the 70s raised interest rates to 20% because we had the 70s were a decade-long high inflation. So somehow people have that in the back of their mind that Director Powell is going to raise interest rates a bunch, and he did. It was absolutely crazy. He raised interest rates 0.25% in March, and the markets went nuts, right? So we are actually at 25 basis points, and he mentioned he was going to raise interest rates about 1.75. And I don't know if Alex is going to expound on this, but it's almost as if Wall Street said, we did it all in one foul swoop. We did it immediately, and he's going to keep doing it every 6 weeks. In reality, he hasn't. So Director Powell seems to be pretty consistent. I would imagine tomorrow he'll give us what he said he was going to, which is 50 basis points. But again, the part that I think is just crazy is look at mortgage rates. When we talked 2 weeks ago, we were talking about this, so we're not going to go on this too long, but I keep looking at a 1-year treasury at 2.45% when 2 months ago it was less than 1%. I mean, the financial institutions have taken advantage of the opportunity of the fear of people thinking interest rates are going nuts, and they've moved them up and tried to make more money on their loans, et cetera. That being said, it's definitely hurt bonds. We haven't really addressed it, but as of today, the S&P 500 is down just under 13% year to date. The big losers, probably the tech companies, the NASDAQ, which is down about, I think, Robin, you said me about 22% year to date. We've been more of a value player trying to get dividends. And then again, we've been pretty consistent. If you can pass off inflation, to your customers and you can make the same amount of profits, you should do pretty well, which is the value side. So we've been trying to buy more value, and our portfolios have done pretty exceedingly well, except our darn bonds are not holding like they used to. But again, with a bond, it's a loan, and if you hold it long enough, you can get that paper loss back. And so I feel pretty good about where we are. And the market again is for some reason just completely overreacts from the Fed talks. Then the Fed does exactly what they said they're going to do, and then the market calms down until the next Fed meeting. And everything I've been reading, it says we should probably continue that. You're right, Robin. I have received probably more phone calls and emails this most recent downturn, even though as we look at it today, May 3rd, it's no different than it was March 7th, the exact same number. Same thing it looked like around I think it was January 22nd. Then again in mid-February, but for some reason, this one feels worse. Maybe there's political strife with what's going on all over the world, and maybe some events that are announced today. But reality is, and I'm going to let Alex talk about this, we're not in that bad of spots. There's a thing called support and resistance, and you can watch it. When the S&P gets to about 4,200, when the NASDAQ gets to about 12,500, when the Dow gets to about 33,000, you see money fly into the market saying, I'm buying at a discount. In fact, probably the most famous person, my daughter goes to school in Omaha, the Oracle of Omaha, always says, be fearful when other people are greedy, and be greedy when other people are fearful. And right now you're seeing many people at Berkshire Hathaway buying the dips. You'll notice yesterday we did the exact same thing. There was a lot of fear, and we bought some NASDAQ for all of our accounts because people were fearful. So we continue to believe it's a buy in a dip market. We continue to believe that this is not some kind of market's overpriced and the pendulum's going to swing and we're going to see this crazy downturn. Like I said, I'm not going to talk much about PE ratios. I think that's interesting for Alex, but I'm not overly concerned.
Just Alex.
Yeah. Well, you and I will just sit down and be quiet here in a minute.
Nobody else likes them.
It's funny, Berkshire, you're right. Yeah, they put $51 billion in the market last quarter. I don't know that we put the same amount in yesterday, but rough numbers.
Right.
And then mortgage rates, I don't remember. I know it was a couple of weeks ago, but I think they were darn near 5 last time we talked, and now they're probably up to 5.5 just over the last couple of weeks.
I think they've come down off their peak a little bit because the market did, as Dan say, again, the Fed says we'll probably raise rates, up to a couple percentage points. And again, what they've done so far is a 1/4 point raise, and bonds have gone up by 2%, mortgages have gone up by 2.5%. All of that based on a 1/4 point raise? No, it's the anticipation of all the raises that they've talked about doing this year. So the good news is we probably won't see rates continue to go up significantly from here. When they raise rates tomorrow, that should be priced in. And so a lot of the headwinds that the stock market has been facing by rising interest rates should already be priced in. And other things is, yes, bonds have gone down a lot because their price declines when their yield goes up. But again, that should also have we should have seen the worst of that, and that should come to an end more or less in the near term. And we'll be making up some interest now as time goes by. So the bonds will catch up throughout the course of the year. They haven't had a chance to pay interest, as much interest yet, but by the end of the year, they will have paid out a full year's worth of interest, and that should offset most, if not all, of the losses they've seen in the first quarter.
Yeah.
So
Alex, and many of the emails, I think, and phone calls we got were basically because April numbers, right? Just to give you guys some just numbers, not year-to-date numbers, but April, I think the NASDAQ was down 13 alone. Bitcoin, 18% just for Bitcoin last month, and the S&P was down 9. But Alex, talk to us because we want to hear some good news. Tell us, you're just talking about the PE ratios earlier today. Tell our listener what you told us about.
So PE ratios, again, is a relative valuation, measure. So it gives you an idea, if I say a stock's $100, that doesn't tell you if it's cheap or expensive. Using a PE ratio compares the price to the profit of the company. And what I can tell you is PE ratios went nuts during the pandemic because there was free money. We saw the NASDAQ at 40. one of my least favorite stocks, hit a 1200 PE ratio. Okay, so the S&P was, close to 30. Right now, the S&P 500 is at just under 19 on a forward basis. And what's interesting about that is if you forget about, everything that's happened since March of 2020 until now, well, PE ratios haven't moved. So pre-COVID, the S&P 500 PE ratio was just under 19. Now it's just under 19. The difference is we have a $9 trillion balance sheet for the Fed. So there's a lot more free money out there. There's a lot more jobs. The economy is growing more strongly than it was then. And yet PE ratios are where they were, 2 years, 3 years ago, 2 years ago, I guess. So what I'm trying to say is the market has shed its overpriced, a lot of the overpricing that we saw. And, we're no longer looking and saying, boy, look how expensive it is. It's now much more reasonably priced. And the economy is strong. So going forward, there's an opportunity for the market to do reasonably well. Mm-hmm. Also, the big fear is interest rates take money away from the stock market because they're a competitor. Well, they're already there. We're seeing interest rates at, 3%, 5% for mortgages. If money's not flowing into that now, it's not going to flow into it in 6 weeks when they stay at the same rate if they do.
Yeah.
And that's the optimistic
market. You had mentioned that you think the market is, basically priced in everything that the Fed's going to do this year. The Fed's obviously going to be acting next year as well. Do you think it's got some of that priced into?
No, I don't. And obviously, if there's changes to what we think the Fed is going to do, then that's going to change pricing. But the big reason the Fed is increasing interest rates is because of inflation. I got to believe, and the preliminary stuff that I'm reading says that putting mortgage rates to 5.5% put a teensy bit of a damper on the real estate market. Yeah. So, and the auto market has started to soften. A lot of markets are going to start to soften as the free money's gone and interest rates are high. And what that means is the Fed doesn't need to raise rates as much. I mean, back to what Dan said at the beginning, at 20%, mortgage rates or CD rates, I don't see that happening. I mean, we're going to get this under control relatively quickly, as soon as we stop the excesses of 2020 and 2021.
Yeah.
Right. I mean, we went
nuts.
I
sure hope not. I'm trying to buy a house right now, Alex.
Well, you and a lot of other people.
Right.
Again, I think the real estate market by midsummer is going to be much more reasonable across most of the country. Not as much competing bids, one buyer, longer days on market, that sort of thing. Right. So
yeah, I'm still interested to see what's going to happen in Tucson, just where we are, though. Phoenix has definitely had their day in the sun, where their real estate is just could continue to go up. And I guess there's more jobs and stuff there, but it's interesting. Tucson seems like still a very good value comparatively to the nation, anyway.
Yeah,
so interesting to see.
Interestingly enough, one dark spot in the economic news, which is kind of funny because it's the opposite of what you think. We now have, once again, a record number of unfilled jobs. I think we're up to, did we get up to 12 million or something now? So 4.5 million people quit their jobs again last month to find better jobs. The reason I say that's a dark spot is, well, why do you think they quit those jobs? They found a better one.
Yep.
And what does it mean if they found a better one? Probably means they're getting paid more.
Yeah.
Okay? And if they're getting paid more, that means they have more money. That means more inflation. So that would be kind of the dark spot in the data that we've seen, leading towards this inflation maybe a little more persistent than we hope. But hopefully that number will come down, because we can't just keep creating more and more open jobs, in this economy. That's right. A bit too many.
Yeah. Well, Alex, I hope you and I get to enjoy ourselves tomorrow. Maybe when the Fed comes out, we'll try and read between the lines of all the questions he gets, because that's what makes the market move, it seems. Guys, I know that you've planned a lot of things for Mother's Day weekend this weekend. I just want to remind you that KFC is also offering a fried chicken floral arrangement if you haven't got something already.
Well, we don't want to show up your wife with taking the same thing.
Anyways, we'll keep it nice and quick today. Not much is, we will wait for the Fed, but we'll do this again soon. If you've got any questions for us, please don't reach out or don't hesitate to reach out. You can find us at ironwoodfinancial.com. You can reach us at 1-888-271-4646. If you are not a client of ours and you'd like to chat, please don't hesitate to reach out to us. Guys, I will see you soon. We'll do this again. And I hope you guys have a great rest of the week. Stay safe.
Take care.
See you guys.